Right, so let's get back to the broader market and earnings season. Our guest is focused on the energy and materials sector, both of which have been climbing this year. As of this morning, they were up more than 9% year to date. Let's get more from Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Brian, always great to see you. Thank you very much indeed.
Thank you.
Just to clarify, are we talking US or Canadian stocks here mostly?
Well, both, because really the raw materials are what at play here. Copper, as you were talking about before, is a major contributor to what we're trying to do in growing the power that's going to feed into AI data centers. So what we're finding is the capex spending from those very large tech companies is starting to land on the balance sheet of mining and materials companies, in that we just simply need more of that raw material in order to provide copper to wire data centers, grow the power grid across, boundaries, if you will.
What would be your favorite way of playing copper? ETFs are a little hard to find in this space. There are moves to launch them, I know. Would you buy the likes of a Freeport-McMoRan, for example?
Right, exactly. Or, even an Albemarle or a Newport, something along those lines that are actually directly involved in the mining and processing. Obviously, the smelting and refining of copper is going to be a big part of this as well. So I would like any of those names. And then on the offset of that, in the same energy lane, looking at those utilities companies that are going to be actually producing the electricity that runs on the copper, obviously, that's a way to offset it as well.
What about uranium stocks? They've had a magnificent run.
Yeah, absolutely. I think the expectation globally is that there's going to be more nuclear power generated. It's just a process of getting those new power plants online, but definitely they need that raw material in order to make it happen. So yes, I think those mining stocks, again, even something like a 3M that's going to be directly involved in actually getting the material out of the ground, those are great ways to play the spend that's actually happening.
How are you handling the big defense stocks? Are you attracted to the likes of Lockheed Martin, for example, right now?
I am. And obviously, there's growing defense spending, which is always good for their bottom line. They have some very durable government contracts. But also at the same time, their expertise in a lot of this really intricate engineering that's going to happen in the build out of data centers makes them an applicable play in the AI spend as well. So they are starting to contribute to some of the design work, if you will, in these very large construction projects that have been happening, in both countries.
It sounds like you are watching investor wariness over some of these giant AI names. I mean, we saw a big correction in Oracle, for example, amid debt concerns, ORCL. Are you steering clear of some of these tech names?
Well, I think the question is starting to be properly asked, and that is, with all of this spending that's happening, we're approaching, $1 trillion in capex spending for AI infrastructure just in the next couple of years. When does that come back to these technology companies, and will it be a profitable investment on their part? In the meantime, before we wait that out, we just simply follow the money, knowing that they're spending real dollars on building AI infrastructure. We go to the companies that are benefiting from that. And that's why we like some of these other sectors rather than just continuing to own the same Mag 7 names plus Oracle, Broadcom, Palantir. There's a way to simply follow the money that they're spending to grow the overall compute picture, which eventually will come back around to them, but might take another couple of years to get that compute capacity to grow where they need it to be.
What about the big U.S. banks? There's talk there's going to be a whole bunch of mergers and acquisitions this year, perhaps in technology, and perhaps a whole bunch of high-profile IPOs. That'll be good for the Wall Street banks.
Yeah, that investment banking part would be a really nice growth source. We saw obviously some trading volume that really boosted revenues for a lot of the larger banks last week. We saw, earnings up roughly 19% year over year. That's helping to boost profitability just from the trading volume. If that then transitions into more of the investment banking, then we would absolutely be excited about financial services right now. In the meantime, we've got a Fed meeting here in the U.S. this week. It's a 97% likelihood that nothing happens. And so that means the cost of capital is remaining static. In order to get to that IPO market and those mergers and acquisitions, we need to see the cost of capital come down, because that would be more of a growth impetus for these companies to actually engage in those transactions. As long as the 10-year Treasury here in the U.S. is above 4.2, it's really difficult to see those structures of transactions coming down. So really what we want to see is the long end of the yield curve come down. Once we get below 4% of the 10-year, a lot more of these deals become more likely.
Let's put up a chart for the 10-year bond yield, maybe over the past 5 years. What was the crucial, the possible catalyst? What level of the 10-year bond?
I think under 4 for the U.S. Treasury is an appropriate level where you'll start to see an acceleration in deal making, both in the IPO side, but also on the M&A side. Now, the thing is here, we've had 6 rate cuts over the last 18 months, but the 10-year has been sticky over that 4% number, at one point reaching 4.5, coming back down, and we're kind of settled into this range at around 4.1 to 4.2. We've got to get that lower by 25 to 30 basis points or more before you're going to see any real increase in deal making.
And what SpaceX is going to be a huge one, presumably this year. It could be one of the biggest ever. Do you think? I know it's very early, but do you think that would be an IPO you'd be interested in?
I would say yes. I mean, I think that they've built a business here that makes a lot of sense. There's already a revenue stream that you could project future earnings growth on, and you could see the road to profitability. They just simply have the most, I think, cost-efficient, repeatable process to get men and material into space. Yeah, I think that would be definitely a very exciting name, no doubt about it.
We'd better go. Thank you very much indeed. I really appreciate it.
Thank you.